Good day, everyone. You are welcome to this week's Business and Investment Tips program, a production of RCCG Christ Church Radio with Ayodeji Ebo, an investment professional. This week, the focus is on the implication of the CBN's interest rate hike. The Central Bank of Nigeria's Monetary Policy Committee had its fifth meeting last week, Monday and Tuesday, 26th and 27th September 2022, respectively, to discuss global and domestic developments since the last meeting in July 2022. The MPC is the highest policy-making committee of the CBN and is composed of an 11-man committee, including the CBN governor. The MPC meeting holds bi-monthly, with one more expected meeting this year. Remarkably, members of the MPC voted unanimously to raise the monetary policy rate, MPR, for the third consecutive time this year, and the cash reserve ratio, CRR, for the first time in 2 years, to narrow the negative real interest rate gap and rein in inflation. 10 members voted to increase the MPR by 1.5%, one member voted for a 1% increase, and another voted to raise the MPR by 0.5%. Also, 10 members voted to increase the CRR by 5%, and 2 members voted to increase CRR by 7.5%. Overall, the MPR was raised by 1.5% to 15.5%. Asymmetric corridors were retained at plus 100 basis points, minus 700 basis points around the MPR, and the cash reserve ratio was raised to a minimum of 32.5%, while liquidity ratio at 30% was retained. The MPR is the interest rate at which the CBN lends to commercial banks. The MPR is the benchmark against which other lending rates in the economy are pegged. It is also used as an instrument to control inflation in the economy. Though the MPR has been ineffective in recent years, the rate has been used to signal CBN's intentions. Cash reserve ratio is the minimum amount banks are expected to retain with the CBN from customer deposits. This implies that out of every 1,000 naira deposit collected by the banks, 325 naira is expected to be with the CBN. Effectively, the bank can only transact business and earn income with only 675 naira out of the 1,000 naira. To understand more about other key rates, kindly listen to our previous podcast on this topic, link inserted. What are the implications of the rate hike? 1. Rise in interest rates on savings accounts. Recently, the CBN reviewed the minimum interest rate on savings account to 30% of the MPR from the previous low of 10% of MPR. As a result of the current increase in MPR from 14% to 15.5%, the minimum savings interest rate will increase to 4.65% from 4.2% per annum. However, this is subject to other conditions which vary across banks, like limits on the number of withdrawals per month to qualify for interest. 2. Higher fixed income rates. We expect yields to rise as a result of the rate hike, which will reduce the negative real rate of return and boost domestic participation. Following the CBN's decision to raise the MPR and CRR, the Treasury Bills primary market auction, which held a day after, saw a 2.25 percentage point jump in rates on the 364-day bills to 12%. However, this will result in few commercial paper issuances by corporates as investors will demand a greater premium. 3. Higher borrowing cost. The increase in the CRR to 32.5% implies that banks have less funds to generate income, as 32.5% of customers' funds would be with the CBN at zero cost. This excludes the discretionary CRR by the CBN. Hence, the bank will need to charge a higher interest rate for lending to cover the income gap. This will result in higher borrowing costs for smaller businesses and households, potentially causing a slowdown in economic growth. This will affect existing loans without a fixed rate agreement clause, as most banking loans are floating or variable rate based. This means that the loan rates can be revised upwards or downwards during the lifetime of the loan. Also, the rate at which the CBN loans money to the bank through the Standing Lending Facility (SLF) would increase with the hike in MPR. 4. More hard times for businesses. Given the increased cost of lending to small businesses, A rate hike will result in an increase in finance costs, thereby shrinking the business profitability margin. Businesses are also unlikely to refinance existing debt, which could slow investment in their operations. Businesses with inelastic demand for their product will pass the increased cost directly to the consumers, leading to lower purchasing power. 5. Mixed impact on inflation. Although a rate hike generally tames inflationary pressures by slowing down consumer spending, it is important to note that inflation in Nigeria is mainly driven by supply constraints rather than increasing aggregate demand. So, a rate hike might not be sufficient to bring down inflation. The pass-through effect of higher production costs will lead to higher prices and higher inflation rates. However, if the rate increase encourages more savings in naira rather than dollars, it could help ease pressure on the currency and reduce imported inflation. 6. Weaker investor interest in equities. The rate hike will further dampen investors' interest in the equities market as fixed income instrument becomes more attractive. We expect to see a continued rotation out of the stock market and into the fixed income space. While we advise you to maintain caution when buying stocks, you can consider positioning for undervalued stock with attractive dividend yields. The last MPC meeting of the year 2022 we hold on the 21st and 22nd of November, where we believe the MPC may adopt a wait-and-see approach to assess the impact of the cumulative 4.0% increase at the last 3 MPC meetings this year. In our view, we do not expect inflationary pressures to abate given the underlying structural issues and continuous low base effects. Thank you for listening. Please join us same time next week for another exciting and insightful session. For questions, comments, and feedback, kindly forward to ebo.ayodeji@gmail.com or send SMS to 070-8246-3747. Stay